Welcome back to Arise Exchange. President Obama dropped a pretty strong hint today that Fed Chair Ben Bernanke is getting ready to call it quits. His term ends later this summer. And if he steps down, who could replace him? And what changes, if any, might we expect? David Goldman is the former head of global fixed income at Bank of America, now heads his own firm, Macro Strategy. And welcome to Arise, David.
Thank you, Andrew. Pleasure to be here.
Let's start with Ben Bernanke. We watch him like we watch the Pope, waiting for the smoke signals to come out as to whether he's going to leave and who might replace him. Do you think he's going to step down?
Without any question. I don't think Bernanke enjoys his job at this point because he's gotten everything wrong. And one of the reasons the market is so volatile is because Bernanke has gotten things wrong. They're not sure how he's going to react to a set of errors which he's set in motion. And
wrong being the bond buying program, the $85 billion each month?
He thought that the $85 billion a month bond buying program would get you to 2.5% inflation. 2.5% inflation would be good in his view because it would make people sell financial assets and buy real assets and get investment going. But no such thing has happened. We have less than 1% inflation, and we have the worst investment climate we've had in the whole post-war period.
And we're also set up for a potentially big fall, especially overseas markets, because they are tied and addicted to all of this free money, the argument goes.
Well, that's true. But a great deal, the problem the market has is understanding how the Fed's going to react to a set of errors. You basically have two groups in the Fed. They've both been wrong. Bernanke has said we'll get a little bit of inflation, that will be good. The other group has said we'll get a lot of inflation, that'll be bad. And in fact, we've got no inflation, so they're both scratching their heads, wondering what to do next. And you can bet, since they've got no idea what went wrong, they won't do anything.
Well, I was going to ask you that. Do you think Bernanke leaves before making any decisions here and just gets out of town?
Absolutely. Bernanke is going to declare victory and go home, like some people said at the end of the Vietnam War, and he'll retire happily and leave the mess to his successor.
Okay, so do you want to see a successor then who is more hawkish on these issues?
I want to see a successor who agrees with what our greatest Fed chairman of the post-war period, Paul Volcker, told us in a speech 2 weeks ago, which is monetary policy alone is not enough. You need fiscal incentives for growth. You need to remove regulatory obstacles to growth. The Fed can't do it by itself. It's like trying to row a boat with one oar. You go around in circles.
Mm-hmm. So you need Congress support, you need regulatory reform, and you need a monetary policy that is less aggressive.
Well, I think monetary policy has to focus on stability. The problem is if you say, everybody have a party, but we're going to take it away when you get too happy.
Yeah, well, that's what's happened. Yeah.
No one can make long-term decisions. So people are making short-term decisions. Andrew?
You know, I'm always a little bit surprised by all of the volatility that we're seeing. I mean, did people not know that at some point this was going to come to an end?
Well, but people have got to make money. So you go to the volcano and you pick up the nickels in the volcano and you hope to get out before the eruption.
That's a good analogy.
You know, you don't see the eruption. You just have to have somebody shout smoke and everybody dashes for cover.
Okay, so who do you think could possibly replace Bernanke, and who, frankly, will this president pick?
I think you're going to get a dud from this president. My guess is it'll be somebody like Timothy Geithner, with whom he has a good personal relationship, or possibly Janet Yellen's been talked about. This will be a dovish administration. I prefer somebody who understands both tax and monetary policy, somebody like Glenn Hubbard, who served in the Council of Economic Advisors. I believe he's dean of the business school at Columbia right now, would be my kind of choice, but I don't think Obama would pick him.
Okay, so how much of the global markets and even the Dow, therefore, have seen this rally this year based on the environment that we have right now, the low interest rates and the easy money? And if so, what is your concerns when that starts to come to an end?
Well, I think that the rally has been very much driven by easy money. If you look at the first quarter, we had declining top line, declining revenues, but increased per share profits. That's because companies can borrow very cheaply, cheaper than ever in the past, buy back their own shares, so there were fewer shares with which to distribute those profits. So per share profits go up. Cheap money is really driving this in a very poor economic climate.
And the earnings growth that we've seen from the companies is not coming from top line growth.
No, overall profits are down in the aggregate, but per share profits are rising because the number of shares is dropping by about 5% a year.
Okay, so how much volatility and trouble do you think we're in there for the next 3 months? I mean,
well,
can we weather this? Can Bernanke start taking some measures, in your view, to soften this blow if you say he's made so many errors, or are we at this point too far down the road?
I think if the Fed says, We have a non-inflation environment. We're going to try to keep a low inflation environment, so there's no reason for interest rates to go up as long as inflation is extremely low. The market will figure out the sort of thing that it did today. Bond yields are going nowhere, in which case the volatility should leave the stock market.
Well, Ben Bernanke has basically been saying that, hasn't he, that he could taper back without raising interest rates.
But what Bernanke has made the whole thing dependent on getting sufficient economic growth. We haven't gotten the growth. And also getting sufficient inflation. We haven't had the inflation or the growth. So the Fed's model has left the market wondering how Bernanke will respond to his own disappointments. And that's what creates the volatility. The Fed has got to change its set of expectations and give the market a clear perspective. Right now, you're talking about the whims of one guy or a very small number of people, and the market is going to be volatile as long as we're dependent on that.
Okay, David, thank you so much.
Andrew, pleasure.
David Goldman, the head of macro strategy, and you are watching Arise Exchange.